What's going on, guys? It's Jimmy here. Welcome to our daily show where we discuss everything going on here in our country that you need to know about here on a daily basis. We got some major things to talk about here today. Also, the Fed with their most recent interest rate hike again of 0.75%. This is their third in a row of 2.25% just in the last 3 months. Forecasts hiking interest rates as high as a 4.6% before ending the inflation fight. So raising interest rates by 4.6% before actually stopping. Here's the details on this. The Federal Reserve will raise interest rates as high as 4.6%. Remember, this is the rate that kind of goes to bank rates. This isn't like what mortgage rates are or credit card rates are, because remember that mortgage rates are already in the 7%, 6-7% range already. So this is kind of like the prime rate per se. In 2023, before the central bank stops its fight against soaring inflation, according to its median forecast released here this week. The Fed on Wednesday raised its interest rates by another 0.75% to a range of 3 to 3.25, the highest since 2008. So this means here that we're probably in for yet still another 1.5% of interest rate hikes still yet to come. And the Fed also said no relief in sight as bruised markets and the Fed signals higher rates for longer. And remember that these are just estimates, and the estimates have been completely blown out of the water now. So we could see even higher interest rates than what they're projecting now, because what they projected previously have already been blown out of the water. So what they're saying is higher interest rates for longer to combat the terrible inflation that we have right now. Here's Jerome Powell, the head of the Federal Reserve. Take a listen.
Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control. And that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year, expansions. And you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen in since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises. And so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Yeah, so this is part of the Great Reset, and Federal Reserve Chairman Jerome Powell has actually said that he needs to reset the economy. He actually said that the housing market as well is going to go through a reset and a correction. A correction of the housing market would be a 20% drop. So a $400,000 house would drop $80,000 in value. Anybody going to sell a house right now, that would mean that it would be worth $80,000 less. Yeah, take a listen.
Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market, as you know, where it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
So let me know your thoughts on this reset that the Fed wants to do here for housing, for the markets, for our economy. What do you think? What are their plans here? And interest rates are going to continue to go up more so than they are now. And this is costing pretty much all Americans a lot of money in interest, no matter what you pay, whether it's credit cards, home mortgages, anything. Check this out. Yeah, I thought that this was shocking here. Credit cards, the Fed rate hikes affecting your credit card's annual percentage rate, your interest rate on credit cards, which determines how much interest you pay for any outstanding debts not paid off at the end of the month. If you don't pay it off in full, you pay interest on your credit card debt. When the rate hikes began in early 2022, the average APR interest rate on your credit cards was close to about 16% and have now climbed to just over 18%. And now with the newest interest rate that they just rate hike that they just announced, will reach closer to 19%, according to bankrate.com. In that case, for a credit card balance of $5,000 with an APR of 19% instead of 16%, basically an extra 3%, you'd pay an additional $1,197 in interest costs compared to an APR of 16% if you only made the minimum payment each month. So you're going to, on every $5,000 of credit card balance that you have, you're going to pay an additional up to $1,197 in interest costs. And remember that they're going to be raising interest rates even more so this year and next year to combat inflation. This is just on credit cards. Remember that the average cost of a home now in the US is about $350,000. In some places, you can buy a pretty decent home for that. In some places, you can't buy a home at all for that kind of price. It's literally, you can't even buy a shoebox for that price. But this really depends because, and this is really going to cost a lot of people because a year ago on a $350,000 home, when you were able to get an interest rate of 3% or even lower, your payment would have been just under $1,500 a month, $1,476. But now with interest rates at 7% or even higher, that's going to be $2,329. So that is, let's see here, $2,329 minus $1,476. That's $853 more a month, just in interest. That's unbelievable. That's literally just unbelievable. You multiply that times 12 months, and that's an additional $10,000 a year in interest. That's a lot of money. You multiply that times 10 years, or 10 years, and that's $100,000. Remember, interest rates are going to go even higher, even higher. This is not only a $350,000 home. Imagine if you're in a market where homes are higher than that. It's going to be even more. Yeah, and this is what the cost of inflation and everything is just kind of doing here to us right now. And don't forget that we're seeing this already. Look at the cost of food. Look at the cost of gas. I mean, I know gas has come down for about 100 days now, and it's really kind of stopped. In some places, it's going back up. The cost of food year over year is up 13.1%. So we look at, interest rates on homes have gone up like from 3 to 7. That's about 4%. The price of food has gone up 13%. Just to kind of give you an idea there of how much basically interest rates on food have gone up. It's not pretty here. And really, even with the price of gas having come down significantly, gas and price on gas here is still very, very significant here. You see the national average price of gas here has basically stopped going down. We're at 368 here, 368. A week ago was 369. But you can see here a year ago was 318. So that was 50 cents lower. So that was significantly lower. And the day that Biden took office, the gas price of gas was $2.39 a gallon. $2.39. So we're at 368. A year ago was 318. So you can see here gas is still up pretty significantly from where we were a year ago and from the day that Biden took office. So we really need to see gas come down a lot more, which I don't know if we'll ever get there, especially with the escalation in the war of Russia right now. It's getting really bad over there. They just drafted 300,000 people, some of them kind of against their will. People are fleeing Russia, crashed their stock market. It's crashing a lot of markets around the world here. The U.S. stock market has really been kind of free falling here as well. The U.S. Stock market's down about 20% year to date, depending on which indice you look at. And but last year we were up 27%, so we're kind of at a 2-year low right now. But the real question here is what's going to happen going forward. We know we're going to see more interest rate hikes. And this is going to try to bring down inflation. You can let me know your thoughts here on this. But I'll keep you up to date here on all this. So I'll link you to another video I just did here on the Russia situation and inflation relief checks that are going out to millions of Americans here. There's about 32 different states that are actually sending out inflation relief checks with their surplus money and money from the last American Rescue Plan package as well. And then we also have the student loan forgiveness coming out here. There's actually a lot of different programs here that are going on here. And another major update coming here at the end of this month for the SNAP program as well. So I'll keep you up to date here on all of this here on our YouTube channel. So make sure to subscribe down below. If you haven't yet, it's completely free to do so. Just click the subscribe button, then the bell icon so you don't miss out on new videos. It's completely free, and I'll keep you up to date here. You can click this video here to see my newest video on the Russia war, and that could be really bad here. Brand new details here on that. And here's my newest video on millions of Americans that are getting checks here that you might not even know about. Could be you. So click on one of those videos next. Thanks for watching, guys, and I'll see you in the next video.